Since the 1970s, the global energy market has operated on a single, unbreakable rule. If a country wants to buy oil on the international market, they almost always have to pay for it using American dollars. This map shows the sheer scale of that requirement. Because every nation needs oil, every nation is forced to stockpile U.S. currency. Those dollars flow out to purchase crude and then recycle directly back to the United States through global financial networks like SWIFT. Because America controls the currency routing, it can weaponize the entire structure. With a single sanctions order, the U.S. government can cut off a nation's access to those dollars, effectively paralyzing its economy overnight. When you control the money used to buy energy, you control the geopolitical landscape. Bypassing that currency is a direct challenge to the financial architecture that keeps the United States at the center of the world. In early 2026, the intensifying conflict between the U.S., Israel, and Iran choked off the Strait of Hormuz. With a fifth of the world's oil passage threatened, global energy prices spiked, raising the threat of a global economic crash. Facing immense domestic pressure to stabilize the market, the Trump administration responded with a highly contradictory policy. While actively engaging in the conflict, the White House issued a 30-day waiver allowing countries to purchase unsanctioned Iranian oil at sea. India, desperate for energy, immediately capitalized on the brief window. The state-run Indian Oil Corporation purchased 2 million barrels of Iranian crude in a single transaction. But India didn't settle that $200 million trade using American dollars. They didn't even use their native rupee. They paid for the oil using the Chinese yuan. India is a non-aligned democracy. Why would they execute a critical, survival-level energy trade using the currency of their primary geopolitical rival in Asia? To understand the decision, look at this chart of India's energy deficit. The country relies on foreign imports for roughly 85 to 90% of its total oil supply. They are uniquely exposed to global market shocks. As the conflict drove crude prices up, Indian oil companies began losing enormous sums of money. Even with government tax cuts designed to shield consumers, the domestic cost burden was becoming unsustainable. They needed relief, fast. The Iranian crude sat heavily discounted on the market, offering the exact price advantage India required to keep its domestic economy from stalling. Transacting in U.S. dollars, however, would force the trade through American financial surveillance. Given the erratic nature of the 30-day waiver, relying on the dollar left the entire shipment vulnerable to sudden policy reversals from Washington. India used the yuan to secure its energy grid while bypassing the reach of American financial oversight. If the goal was simply to avoid the dollar, the logical alternative would be for India to pay Iran using the Indian rupee. Under heavy sanctions, Iran is isolated, selling over 80% of its oil to China for manufactured goods. Iran needs spendable currency. A stockpile of Indian rupees is useless, but the Chinese yuan plugs directly into their primary trade loop. To execute the bypass, Indian refiners turned to the Shanghai branch of India's ICICI Bank. They routed the yuan through this offshore hub directly into the Iranian sellers' accounts. In a single move, they constructed a closed-loop financial ecosystem. Energy flowed into India, yuan flowed to Iran, and the United States dollar was entirely removed from the equation. The official stance from the Indian government is that the oil companies operated entirely within the rules of the temporary U.S. waiver. They view this as a demonstration of strategic autonomy, prioritizing national energy security over geopolitical alliances. But that legal protection is temporary. U.S. Treasury Secretary Scott Bessent has already confirmed that the United States will not renew these general licenses, abruptly closing the 30-day window. Regardless of the brief legal window, this transaction provides a working blueprint for de-dollarization, moving millions of barrels of the world's most vital commodity through a system that never touches an American bank. It also exposes a long-term risk for India. By utilizing the yuan for vital energy trades, India is pumping real volume, trust, and structural power into the currency of their largest regional rival. Unlike the dollar, the Chinese yuan is not fully convertible. It is tightly controlled by policymakers in Beijing, giving China increased leverage over any global energy network built on its currency. The weaponization of the dollar through sanctions has incentivized a new parallel infrastructure. In the effort to protect their own energy security, strategic partners like India are building the mechanisms that allow the global oil market to function without American currency.